Thank you for joining us at Cherry Becker for the 2023 Tax Credits and Incentives two-day virtual conference. My name is Ron Wainwright, and I am a strategic tax partner within Cherry Becker's Tax Credit and Incentives Advisory Group. I'm very fortunate to lead our energy practice, and we'll spend the next several hours going through the Inflation Reduction Act and the following agenda. It's great to see that many of you signed in again for our second session today, and we're hoping you to stick around for our 4 sessions tomorrow. We have great presentations planned, and we'll be offering up to 1 hour of CPE per session and 2 hours with this session today focused on energy and the energy incentives. Each session will be led by a partner, director, senior managers, and managers that will be offering up tools, tips, and techniques regarding these topics. We hope you're able to join both days for all of our sessions. Our second session today, as I mentioned, is centered around the Inflation Reduction Act and the various energy tax credits and incentives that were included in this momentous package that was signed on August 16th of 2022 by President Biden, and its 1-year anniversary is tomorrow. I'm joined today by fellow speakers Tim Doran, who is a director in the energy practice, and David Mohimi, who is a manager within the energy practice. So let's get after it. Today, our agenda will be the Inflation Reduction Act and what was its purpose and what has been its impact in the first 12 months. We will go through a deep dive with respect to the energy tax credits and incentives that were contained in this momentous piece of tax legislation of approximately $750 billion. But most importantly, we want to talk to our audience around how to take advantage of the incentives and the credits within the Inflation Reduction Act. So let's kind of make sure we go to the next slide. So these are our speakers, as I've already mentioned. Ron Wainwright, I lead our energy tax credit practice here at Cherry Becker. Tim Doran, who is a director, and well as David Mohimi, who's a manager. It brings us to our first polling question. So how did you hear about this webinar? A, Cherry Becker Tax Advisory Services, an email from Cherry Becker, an email from Avalara, friend or colleague made you aware of the TCIA virtual conference, or you may be a Cherry Becker alumni, or you may have seen this in a social media post. So we'll give you about 45 seconds because we want to make sure we understand our audience. All right, let's post those results. So an email from Cherry Becker, 64% of you. Obviously, we want to make sure that we welcome back our friends and colleagues and Cherry Becker alumni, and certainly those of you who joined us from a social media post, we very much appreciate. So let's get after it from the standpoint of getting into the Inflation Reduction Act. So the IRA overview that we'd like to cover, just from a historical background, and I'm going to ask Tim as well to comment, given his utility background, as he has recently joined Cherry Becker as a director in the energy practice. So from a historical background, I would assume that all of us have read a litany over 2021 and 2022 in regards to clean energy, green energy, and really making the country, as we came through COVID, very sustainable, very independent when it comes to energy. And as we also know, when we think about the US grid, it's approximately 60 years old. So from a historical background, this act came about underneath President Biden to really drive the country to more energy efficiency. Tim, you want to comment from a utility side of what you saw as the bill was being created?
Yeah, thanks, Ron. Hi, everyone. As Ron mentioned, I am Tim Doran, director in our energy credit practice. And as he mentioned at the time, I was working for a utility, and it was an interesting kind of development that happened. It's wild that it's been a year, but we were following very closely over the last summer, a couple of different bills. One of them from Senator Wyden that were seeking to kind of reinvigorate the energy credit scene in the United States. Several of them were starting to tail off and were going to be going away, and so there was a renewed effort to bring those energy credits back as we saw, you know, a climate that was looking and seeking to see more renewable energy in the country. And due to politics and some of the goings on with Senator Manchin and a few others, it kind of felt like it was going to be dead, and we weren't going to get one last year. And then lo and behold, it came out, and there's a lot here, and we were surprised by how much came out. So excited to talk about all of that today.
So also from a historical background for our audience, remember that this is the third major piece of tax legislation over an 18-month period. So we started with the Infrastructure Investment Jobs Act, which most people recognize is really building the infrastructure of our country. That was a $1 trillion act. Then in August 9th, which we will touch on today, we saw the Semiconductor, or the CHIPS Act as it was referred to, signed in August 9th of 2022. Then closely followed, to Tim's comment, by the Inflation Reduction Act. Perhaps a misnomer in its title, because it's all about green, clean energy, and really a lot about carbon neutrality, as our first session talked about sustainability and supply chain, and really the carbon emissions. And so we'll touch on some of the credits that are now available around carbon sequestration in our presentation today. But it has its 1-year anniversary tomorrow. So what's happened in that year since August 16th of 2022? We have seen over 400 public and private partnerships entered into, and very large project announcements just with respect to the Inflation Reduction Act around green and clean energy. We have seen that throughout the United States in regards to solar, geothermal, hydroelectric, carbon sequestration credit opportunities. So it is a momentous bill of approximately $750 billion. It is permanent for the next 10 years through 2032. And it includes significant, what we refer to as enhancements and expansions and bonus credits attributable to clean energy initiatives or policy positions that Congress wanted to drive with respect to this. And also, this was somewhat a bipartisanship bill in recognition that the country needed to be energy independent. As we'll talk, there were a couple other areas with respect to some changes from research and development tax credit for startups, and we'll talk briefly on that. But tomorrow we have a full session in regards to the research and development credit and some of the changes that have unfortunately occurred in 174. And then we'll talk about some key revenue raisers that occurred in the Inflation Reduction Act. So again, the Inflation Reduction Act was really introduced and expanded credits that had begun to sunset. Solar is probably one that is easily identifiable since most people are aware of solar. That began to phase down from 30% to 26%, but then underneath the Inflation Reduction Act was put back into the statute and actually enhanced, as we'll talk about, areas where you could see a solar credit, as an example, move from 30% all the way up to 70%. But again, all of the credits, all the incentives, the deductions and the rebates and the exemptions are focused on clean energy. Specifically, what the IRA did was focus on providing incentives for renewable and sustainable energy technology. These technologies are really across the board and impact all in various types of industries, from the industrial side to the pharmaceutical side to the real estate and construction side. I already mentioned solar, but we've seen a significant expansion in wind, geothermal, combined what are referred to as heat and power systems, carbon capture and the 45Q carbon sequestration credit. And then ultimately, we've seen a real shift in clean hydrogen. So there are two different types of hydrogen, which some of you may be aware of. We have green hydrogen and blue hydrogen. Green hydrogen is actually a much more preferred hydrogen renewable energy. And we see projects that are very focused on the green energy side. And then we saw very specific funding in regards to assisting our industrial, our manufacturing side in making investments in their facilities, given the energy pool that they have. And the list goes on. So the industries impacted by the Inflation Reduction Act are across the board, from financial services to life science to real estate and construction, as well as the private equity sector is going all in regards to investments and purchasing portfolio companies that are very specific in building green or clean energy concepts as well as designs. So that is the point of the bill. Let's talk about a couple areas that the bill also included. So as we know, every bill or piece of tax legislation is scored over a 10-year period. As I've already mentioned, the Inflation Reduction Act is permanent for the next 10 years, beginning January 1 of 2023. But however, it did contain some revenue raisers, because ultimately the bill needed to be scored below basically a ceiling amount. So we saw within the Inflation Reduction Act an extension of what's often referred to as 461L, which ultimately limits an individual taxpayer's deduction on business losses which are generated in a tax year. So that was a revenue raiser. We saw corporate alternative minimum tax provision. So we now have a new book, AMT, which is effective January of 2023. And basically it applies to domestic C corporations with 3-year average of financial statement income of more than $1 billion. This is the comments that President Biden has made in regards to ensuring that all taxpayers are paying their fair share. We also saw a new tax, a 1% excise tax on corporate stock buybacks. As the economy was, I'll say, going through COVID, we saw a number of major corporations buying back their own stock, and therefore this was a new provision around a 1% excise tax on the buyback of that stock. And then ultimately, one area that you may have read about significantly was in regards to the funding of the Internal Revenue Service. So it did in fact increase the IRS budget by approximately $80 billion over the next 9 years. A lot of that was technology towards really making the Internal Revenue Service a much more efficient organization, given some of their antiquated technology. I already mentioned the corporate AMT. Ultimately, this got eliminated by the Tax Cuts Jobs Act, but it was resurrected underneath the Inflation Reduction Act. And basically, it's a 15% corporate income tax, minimum tax on the adjusted financial statements for the tax year, as I mentioned. Again, the threshold is ultimately a very large corporation, but ultimately it can be reduced to 100 million in the case of certain foreign-owned corporations. This brings us to polling question number 2. Has your company previously utilized the research and development credit? Yes, no, not sure. We'll give you all about 45 seconds to answer, and then we'll post the results. All right. Yes, which is a great answer. And that actually is a national trend of about 30% of eligible taxpayers take advantage of the R&D credit. And no, about 47%, and then 23%. No, 23% as well as the 47%. Obviously, I would encourage that 70% to listen in very intently tomorrow as we go through the research and development credit session. So one of the reasons we set this polling question up was intentional in regards to some of the changes that we saw. So we saw a change in the Inflation Reduction Act, just to highlight it before we really do the deep dive in energy, where there was a change in regards to the research and development tax credit, specifically around the employer tax or payroll tax liability. But it ultimately, because it was in the statute at $250,000, but it then doubled or made the eligible amount up to $500,000 for what would deem to be or defined to be startups. So a significant opportunity as we saw startups across the country, specifically during COVID, as well as we see it in the technology sector. Obviously, the benefit of this election is it's available to early stage businesses that have a limited history of generating revenue, but it enables companies to ultimately monetize their R&D tax credit before income tax liabilities realized, i.e. that they're being offset against the payroll tax liability. So this brings us to polling question number 3. Has your company expressed interest in investing in clean energy technologies? Yes, no, or I don't know. Take about 45 seconds, we'll post the poll, and then the good stuff begins as we do a deep dive into the energy tax credits and incentives underneath the Inflation Reduction Act and some of the what we refer to as bonus credits, and we'll get into transferability and direct pay, some of the critical concepts, as well as prevailing wage and apprenticeship, some of the key platforms there. So yes, 38%, no, 34%, I don't know. Again, I would encourage you from the standpoint of investing in clean energy technologies as we go through the presentation to focus on that, because there are significant incentives are really putting cash back in your pocket. So David, I'm going to turn it over to you, and let's go through energy tax credits incentives. Specifically, let's talk about what was boosted underneath the Inflation Reduction Act.
Thanks, Ron. Just a little intro for myself. I am David Mohamani. I'm a manager in the tax credit investment advisory team, focusing on the renewable energy portion. The first credit we're going to discuss today is 45L. This is a credit for energy efficient home construction. Due to the IRA, it was expanded and extended through 2032, and the maximum credit was increased to $5,000, up from $2,000. The credit provides a $2,500 credit for new homes meeting the Energy Star standards, and then $5,000 for certified zero energy ready homes. Obviously, the credit is beneficial to home builders. The next credit I think we're going to dig into is Section 179D, energy efficient commercial building deduction. This is Ron's wheelhouse. The IRA really made 4 key updates to 179D. The first one being an increase of the maximum deduction to $5 per square foot for qualified buildings, reducing the qualifying threshold of calculated energy cost savings from 50% down to 25%. The ability for a tax-exempt owner of a building to allocate a 179D deduction to an eligible designer of the property, and maybe most interestingly, a 3 to 4 year reset, allowing the deduction to be claimed multiple times for a building, so long as relevant updates were made during that period. Okay, and that brings us to polling question number 4. And that says, were you aware that you could reapply the Section 179 deduction every 3 years? We'll give you guys about 45 seconds or so to answer that.
There's a little bit more background on 45L and 179 Cap D as we wait for the polling. These two provisions actually came within the statute in the Energy Policy Act of 2005. And so they've been in the tax law from 2005 through 2022. But to the comment we've made, as well as David highlighted, significant expansion in regards to the multi-residential credit. Think about apartment complexes, residential homes, moving that to $5,000 per door, as we like to refer to it. And then 179 Cap D moving to $5 per square foot around energy efficiency.
Okay, we're moving on. The next credit we're going to briefly touch on is Section 48, the biodiesel fuel, renewable diesel alternative fuels credit. Not too much crazy happened with the IRA. The IRA extended the $1 per gallon Section 48 credit through December 31st, 2024. The next one we're going to discuss briefly as well is Section 30C, the alternative fuel vehicle refueling property. The IRA extended the Section 33 property through, or Section 30C, sorry, through the end of 2032. The credit is equal to 6% of the basis of depreciable property, but that rate can be raised to 30% if prevailing wage and apprenticeship requirements are met. Tim is going to get into all the wage and apprenticeship requirements later in the presentation, but that's going to be a common theme, is that these credits will be boosted if they meet certain requirements, wage and apprentice, as well as additional boosters for domestic content and energy communities. And another thing that was added by the IRA is the credit limit has been raised to $100,000. Okay, now let's get into more of the big ticket credits. We have Section 48 ITC. So this provides a tax credit for investment in renewable energy projects. Under the prior law, the ITC began phasing out certain projects beginning construction after December 31st, 2019. But the IRA actually extended the ITC for most projects that begin before January 1st, 2025. For projects that began construction after December 31st, 2019, but were placed in service prior to January 1st, 2022, the credit amount is going to be 26%. The base credit under the IRA is 6%, but if prevailing wage and apprenticeship requirements are met, that credit can be boosted up to 30%, as well as additional boosters that we'll discuss later. And I think the technologies that are eligible for ITC are fuel cell, solar, geothermal, wind, energy storage, biogas, and microgrid controllers, and combined heating power properties. Many of these technologies were already eligible for the ITC prior to the IRA, but the IRA did add standalone energy storage, qualified biogas property, and microgrid controllers.
Yeah, I'll just add in, David, on that energy storage piece. That was a big deal for a lot of folks, because prior to the Inflation Reduction Act, if you were looking to include storage and still avail yourself of the investment tax credit with respect to the basis in that property, there was a lot of discussions around co-locating and what kind of rules and did we need to follow to make sure we could try to get storage. But the standalone storage, you can now do it without any of the other technologies present. So that really changed the game for the implementation of the credit with respect to storing energy.
Yeah, and as we did a case study in the prior session, you saw that we included in that, if you attended, a battery storage system to differentiate the now change in tax law, as Tim commented. So what we see in our practice, specifically with respect to investment tax credits, is we're looking at energy storage and making recommendations to take advantage of that 30% or bonus credits, as we'll talk later, is that when companies are evaluating alternative energy systems, they are embedding appropriately, because of the additional credit, some type of an energy management system or some type of a battery storage system. And the market actually is moving more to what is referred to as a microgrid concept or behind the meter concept, so that companies are in essence storing their own kilowatt hours or megawatts to ensure that they're utilizing the energy before ultimately it's going into the grid, if you will. So David, talk to us about the details of the investment tax credit under Section 48.
Sure. So the ITC is a dollar for dollar credit for expenses invested in renewable energy properties. So for example, let's say you have a project that's placed into service and the qualified energy property of that project has a basis of $1 million. Let's say you hit prevailing wage and requirements, you're gonna get 30%. So of that $1 million, you would get a credit of $300,000 to use against your federal tax liability. Again, the credit could be boosted above 30% if other booster metrics are hit that we'll discuss later on. But yeah, if you have prevailing wage, then you get 30% of the qualified energy property. The ITC is subject to a recapture period of 5 years. If the property is disposed of or otherwise ceases to be an investment credit property within 5 years of placed in service, the percentage starts at 100% of the credit amount. If the property was disposed of or no longer qualifies as an investment credit property during the first full year it was placed in service, then the recapture percentage decreases by 20% for each succeeding year. And additionally, the IRA actually now allows the ITC to be carried back 3 years. It previously had only been one. So that's definitely something that's been very beneficial to many. And now it can be carried forward 22 years, previously 20. I believe we touched on most of the technologies on the prior slide. Okay, now let's get into some of the additional provisions within Section 48. Okay, so Section 48C, the Advanced Energy Project Credit. Effective January 1st, 2023, the IRA extended 48C to include a variety of facilities, including those that manufacture energy storage systems components, property used to produce energy conservation technology, electro-grid modernization equipment that re-equips a manufacturing facility with equipment designed to reduce greenhouse gas emissions by at least 20%, and last but not least, electric and hybrid vehicles. To qualify for Section 48C, you must apply for certification through a process run by the Treasury Department, who will be consulting with the Department of Energy on this. And the project must be placed into service within 2 years of receiving that certification. The amount of 48C credits available will not exceed $10 billion. And similar to regular Section 48, it's a 6% base credit. And then again, prevailing wage, bonus credits, you can boost that credit rate up. Okay, and then we have 48E, which is a clean electricity investment tax credit. So IRA created this section for technology neutral ITC for any qualified electric generating facility and any energy storage technology that was placed in service after December 31st, 2024, which coincides with when the normal Section 48 is set to expire. So it's kind of taking over for one. The one caveat is in the language for what counts as a qualified property is it says for which the greenhouse gas emissions rate is not greater than 0. And again, it has the similar credit rate of 6% base, potentially boosted up as the prior Section 48 credits we mentioned have.
And there's a little bit interesting background to that too, David, before we get to that polling question. This concept is a new concept of this tech neutral idea. And this goes back even to our conversation about the storage. Previously, these credits would outline what technologies were eligible for them between the production tax credit and the investment tax credit. And this new concept of this tech neutral credit, the background there is that the idea was, if the Inflation Reduction Act was successful and we have a large incentive to develop new renewable energy technologies, there's likely going to be technologies coming in the future that wouldn't be foreseeable. And Congress wanted to make sure that they would also be eligible for some sort of credit to continue to provide the proper incentive. And they kind of missed the boat right there with storage, right? Because I don't think a lot of people were thinking storage early on in the previous regime. So that's going to be interesting to see how that new tech neutral credit plays out going forward.
Definitely. Thank you, Tim.
Yeah, the other comment I would make, adding on to Tim's comment, is to keep it more simple and straightforward. When you look at the Inflation Reduction Act and the 2,700 plus pages and the various credits and incentives that were in the act, think about Section 48 in the context as that's an investment tax credit. And as David will soon talk to us about Section 45, it's a production tax credit. So there are a volume of new credits and incentives, but they all trigger off whether it's an investment tax credit where I'm being rewarded for investments, in this case in 48C, in advanced energy projects. And note the language: re-equips, expands, or establishes an industrial manufacturing facility for the production range of clean energy equipment. So what they're trying to do is really drive home the piece and subsidize, incent taxpayers to really begin this new neutral technology concept. And then, as we'll talk later, there's another policy platform under prevailing wage and apprenticeship requirements. But 48E, again, an investment tax credit, expands on that when you think about clean electricity and technology neutral tax credits, as Tim was commenting. And as you can see, usually the base rate is 6%, and then you can earn up to 30, and then above 30%, as we'll talk about energy communities and U.S. component requirements, as well as very specific builds or assets in areas you could earn all the way up to potentially 7%.
Okay, and polling question number 5. Has your company taken advantage of any energy tax credits and incentives in the past? 45 seconds or so here.
Yeah, let's go ahead and post the poll results. So for those of you in the no category, this is an area that you must focus. And those that are replanning, in essence, that 76%, the Inflation Reduction Act is in fact a game changer. For those that are in the yes category, obviously the expansion effective January 1 of 23 of numerous credits that we'll dive into is going to be very important to you as you continue to evaluate. We like to say we assess, we identify, and we assist you in quantifying the credit and incentive opportunities specifically around energy for you. So David, why don't you talk to us to my comment about the differentiation between an investment tax credit under 48 with a series of those, and now 45 in production tax credits.
Yep. So Section 45 is a tax credit, like Ron mentioned, that is available to the production of electricity from renewable energy sources. Prior to the IRA, the PTC was largely going to become unavailable for projects that began construction after December 31st, 2021. But the IRA extends the PTC related beginning of construction deadline to projects that begin construction on or before January 2025. One of the more important things the IRA did for the PTC, it also opened it up to solar technology. Before, solar was only eligible to take the ITC, whereas now you can elect either the PTC or ITC for solar. The other types of technologies that can generate a PTC would be wind, biomass, geothermal, small irrigation, landfill and trash, hydropower, and marine and hydrokinetic renewable energy. The base credit rate is 0.3 cents per kilowatt hour, adjusted for inflation. And then again, the credit can be increased if it meets prevailing wages and other stackable bonuses. And we'll get into more of the details on section 45 in the next slide. Okay. Okay. So I think one of the major differences is the ITC. You get that credit in the first year in which that project has been placed into service. Whereas the PTC is a 10-year credit period for when it's placed in service, where it's generating that production and you're getting a credit for that. The credit rate is adjusted for inflation annually, and that updated rate is usually released by the IRS. I think one common question we get a lot is it possible to elect both the ITC and PTC for the same facility? Unfortunately, no. You can't double dip and get them both for the same facility. I think one thing that we've been able to help clients with is figuring out, their situation and which credit works better for their circumstances, and what, their financial profile looks like and what makes sense to them. That's one thing we've been helping clients with a good amount, because it's new to a lot of people. So definitely understand, we're here to help you guys through that if you have questions that come up.
So to David's comment, one of the things we do on the energy team is we will complementary model once we've assessed, identified, and quantified the opportunities around energy, and we will show you a model that kind of compares Section 48 ITC versus, if you wish to look at a 45 production types credit, what's the more valuable between the assets, if you will, that are generating either ITC or PTC. David, talk to us about some additional provisions that we saw within Section 45.
Yes. So 45U, the IRA created a new zero emission nuclear power production credit for producing electricity at qualified nuclear power facilities that is sold by the taxpayer to an unrelated person. A qualified nuclear power facility means any nuclear facility that is owned by the taxpayer, and uses nuclear energy to produce electricity. Is not an advanced nuclear power facility as defined in Section 45J, and is placed in service before the enactment of the section. The base credit amount is 0.3 cents, similar to the regular PTC. And again, there are, prevailing wage and apprenticeship requirements. I think the next credit we're going to talk about, 45Q, the credit for carbon oxide sequestration. That's been a very common topic, question we've been getting on. So the IRA extended the beginning of construction deadline to January 1st, 2033. For carbon oxide sequestration. Further, the annual capture requirements have decreased, so you don't have to capture as much. For the following, for direct air capture facilities, it's 1,000 metric tons of qualified carbon oxide. It's 18,750 metric tons for electricity generating facilities with carbon capture capacity of 75% of baseline CO2 production. And for any other facility, it's 12,500 metric tons. The credit rate is $17 per metric ton of carbon dioxide captured and sequestered, $12 metric ton for carbon dioxide that's injected for enhanced oil recovery or utilized, and then 36 for direct air capture facilities. The next credit we have is 45V. Well, I think we want to back up a slide. If we could. One more back, I think. There we go. Okay, 45V, clean hydrogen production tax credit. So this PTC under the IRA for the hydrogen is a PTC that applies to hydrogen produced after December 31st, 2022. Has a 10-year term beginning on the date a qualified clean hydrogen production facility is placed in service. To qualify, the qualified facility must begin construction before January 1st, 2033. For a taxpayer to be eligible for the hydrogen PTC, its life cycle greenhouse gas emission rates cannot exceed 4 kilograms of carbon dioxide equivalent per kilogram of hydrogen produced. And then the base credit is 60 cents per kilogram multiplied by the applicable percentage, ranging from 20 to 100%. The percentage applied is determined by the cycle of greenhouse gas emissions rate, the life cycle greenhouse gas emissions rate. And last but not least, we have 45W. This is a credit for new credit for qualified commercial clean vehicles acquired before January 1st, 2033. The credit amount is a lesser of 15% of your basis in the vehicle, which 30% though if the vehicle is not powered by gas or diesel internal combustion engine, or the incremental cost of such vehicle, which just means the excess of the purchase price of the vehicle over a comparable vehicle. And the credit amount is $7,500. The max is for vehicles weighing less than 14,000 pounds, and then 40,000 for all other vehicles. Okay, so 45X, we have a whole slide in a couple of minutes dedicated to this. I don't want to get into too much detail on it now, but it's a credit available to those who manufacture certain components of related to renewable energy, and the credit rate really varies upon the type of technology each component is. But again, we'll talk about that in a couple of minutes. So then we have 45Y, which is available for clean electricity produced at a qualified facility that is placed in service after December 31st, 2024. This coincides with the expiration of the original Section 45. Just kind of going to replace original Section 45. It is used to generate electricity and has zero greenhouse gas emissions. There is a phase out scheduled for this particular credit, 45Y, and the phase out is going to start at the later of either 2032 or when you have U.S. greenhouse gas emissions from electricity are 25% of the 22 emissions or lower. Again, same credit rate of 0.3 cents per kilowatt hour, adjusted for inflation, as the other components of Section 45 we've discussed so far. And we have 45Z. 45Z provides a tax credit for the domestic production of clean transportation fuels, including sustainable aviation fuels. The Section 45 tax credit applies to fuels produced after December 31st, 2024 and sold before December 31st, 2027. The amount of the credit ranges from 20 cents a gallon for non-aviation fuels up to 35 cents per gallon for aviation fuels, multiplied by an emissions factor. Okay, and I think we have polling. I think there's a polling question. Yep, there we go. Is your company looking to build a new facility in the U.S.? Okay. 15% new. Okay. Okay, new energy tax credits. I think we've touched on all of these, except for 40B. Section 40B is for sustainable aviation fuels, sold after December 31st, 22, through December 31st, 2024. The base credit is $1.25 per gallon of fuel. However, the credit can increase to $1.75 per gallon if greenhouse gas emissions are reduced below 50%. As we talked about earlier, with 45Z, this essentially will replace 40B after 2024. And the next credit is the Advanced Manufacturing Production Credit. So I mentioned earlier, we were talking about this a little later. This is Section 45X. So Section 45X provides a new PTC for each eligible component that is produced by a taxpayer and sold to an unrelated person during the tax year. To qualify, the taxpayer must be in the trade or business of producing and selling eligible components. In general, the term eligible component means any solar energy component, wind energy component, an inverter, which is defined in the IRA, any qualifying battery component, and then any applicable critical mineral. The credit rate varies a lot based upon the type of technology that each component is that is being sold. So there's a wide variety there, and then you can see, some of the eligible components on the slide as well. And then we have our tech neutral credits, PTC and ITC. So as we discussed a little bit earlier, so 45Y and 48E essentially are going to replace Section 45 and 48 respectively for projects that are placed in service after 2024. I think, they're very similar in a sense. One update for what's considered a qualified facility is the inclusion of the terminology for which greenhouse gas emission rate is not greater than 0. So that is, been added to those particular sections, 45Y and 48E. And then one other thing to think about is that netting concepts may apply in this scenario, but it's going to be up to the Treasury to publish the tables for the types of facilities and the specific emission rates tied to that. And I think Tim is going to take over now. Thank you guys for your time. Tim, take it away.
Yeah, thank you, David. So we're going to talk a little bit about this concept of enhancing, as we're calling it, or the base rate or the credit rate increase. So as David and Ron had kind of introduced, these credits, the core investment tax credit, production tax credit, have a new concept that wasn't in the old regime. So just to give you a little bit of a historical concept or historical background, the old regime had kind of flat rates, and the investment tax credit was a 30% credit that then tailed off over time. And so there was a lot of work involving determining when your construction project began and then when your construction project was placed into service, so that you could understand what amount of credit you'd be able to avail yourself of. And it was a similar concept in the production tax credit world. But in passing the Inflation Reduction Act, Congress, in addition to clean energy, wanted to provide incentive with respect to wages and making sure wages were maintained at a particular level, and also wanted to provide an incentive for apprenticeships. And so what they did is they tied a larger credit amount to making sure taxpayers met those requirements that we're going to walk through. And if you do, on most of the credits applicable in the Inflation Reduction Act, you're going to get 5 times that base credit. So if you don't meet these requirements, the base credit of the investment tax credit, for example, is 6%, but you get 30% if you meet the various requirements. And we also recently got some notices from the IRS that we're going to walk through that kind of lay out a little bit more in detail about how you go about meeting these requirements. In addition, there are some bonus credits that are adders. So the way to think about this is if you meet the base credit, you meet the prevailing wage and apprenticeship requirements, and then in addition, you meet one of these adders. We use the word adder because it's additive. So you go from 30%, and let's say you meet this domestic content requirement that we'll talk about, you would actually get 40% of the basis in your project back as a tax credit, which is a pretty substantial amount. This was really a big deal when this was released, and we saw how big some of these credits could get. So we've got the prevailing wage and apprenticeship requirements, and then we've got adders for domestic content, and we'll go through the details of that, but that's basically, are you sourcing what's going into your project from the United States? We've got placed in service in an energy community, and the Congress and the IRS have worked to kind of lay out what defines a geographical area that we're calling an energy community. And if your project is built there, you're going to get this adder. We've got solar and wind facilities with a maximum output not to exceed 5 megawatts have a special bonus adder if they're in low income communities. And then we also have this concept of being part of a qualified low income residential business in a qualified low income benefit area. So this is what I talked about. This is the prevailing wage requirement and apprenticeship requirement. And you can kind of think about these two going together because you have to meet both of them to get that multiplier to your base credit. The prevailing wage requirement applies to laborers and mechanics employed on a project. They must be paid the prevailing wages for that location of the project. And we'll talk about how those are determined. And it's really sourced from the Department of Labor, but we kind of got a little more detail on that in one of the notices that the IRS published. And then the apprenticeship requirements, the actual percentage changes, and we'll see a table laid out on what that percentage is. But if you take the total labor hours for construction, repair, and alteration on your qualified energy project, a percentage of them must be performed by a qualified registered apprentice in order to be eligible for this multiplier.
And so, Tim, if I can add a couple comments here, as we are very involved in regards to just kind of working with respect to Congress on a number of provisions from an energy perspective and giving input, not unlike other firms. What Tim just covered were some of the key, what I would call policy areas within the Inflation Reduction Act that a lot of people gave feedback on. Battery packs, we kind of mentioned, was very important when you think about an energy management system and the ability to now have a 30% credit attributable to basically storing your own energy, depending on the alternative energy system you're using. So the bonus credits to the prior slide, very, very important to really move up depending upon that incentive that you're achieving. So that's where I made that comment previously on solar. You literally could get 30 upwards of 70%, depending if you meet those additive or those bonus provisions. What you will find through Section 45 as well as 48 throughout the Act is this prevailing wage and apprenticeship requirement. It is a fundamental policy. And some of you may have seen that Vice President Harris was last week in different facilities really talking about the importance of prevailing wage as well as the importance of apprenticeship requirements. And it really was an identification to say, if we're going to construct these assets and the government's going to help subsidize through some form of a credit or incentive or a deduction or a rebate or an exemption, we want to ensure that those laborers are being paid pursuant to the Department of Labor a prevailing wage. And this is specific to the job, and it is very specific to where the asset is located. That ultimately determines how we determine whether you're going to meet the prevailing wage. And the apprenticeship requirement was really a recognition that when you think about, I'll say, trade schools and community colleges and other types of universities throughout the country, there was a recognition of that we needed to put really a steroid shot when we thought about construction, repair, alteration of these energy facilities, including some of the slides we already showed you around a manufacturing facility where they were rebuilding to build energy equipment. So as Tim will walk us through, there are very specific requirements to the percentage of labor hours that must occur and are utilized by, quote, an apprenticeship type program. And all of these have to be a registered program. So from a Cherry Becker perspective, we're helping many clients ensure that they are documenting, substantiating, and can prove the additive or bonus credits, and that they've met the base of the prevailing wage and apprenticeship requirement. Tim, you want to talk to us about the notice that we saw last year and prevailing wage?
Yeah, and thank you for that, Ron. And you know, this documentation is specifically required, you know, to prove out to the IRS if they come knocking that you've met these prevailing wage requirements. And it's a big deal because you're going from potentially a 30% credit to a 6% credit, which is it's a substantial amount of money that you wouldn't be able to claim with respect to your project. And one of the other reasons it's a big deal, and you see on this slide, is that it covers a lot of folks. So even though ultimately the taxpayer is responsible for maintaining that documentation and ensuring that the prevailing wages requirement is met, this applies to anybody who works on the project for remuneration. So we're talking subcontractors, contractors, and even repair work that goes on for a 10-year window after the project is placed into service. We notice on here, one of the things that we got from Notice 2022-61 that was kind of a question mark at first was, how are we going to apply some of the rules regarding begin construction? And for those of you who aren't aware, the previous regime that I talked about had this concept of determining when you were going to begin construction. And there were two ways. There was the physical work test, was a specific test in the code which said, did you begin physical work on a substantial amount of physical work on your project? But there was also a safe harbor that taxpayers were able to rely on. So if they spent up to 5% of the final amount of the project on purchasing, for example, in a solar context, solar modules, then they were able to claim that as the beginning of their construction. For purposes of prevailing wages, and this isn't really going to be as important anymore, but when the IRA was first passed last August, we were waiting on guidance from the IRS as to how to implement some of these things. And so Congress gave taxpayers a break and said, hey, if you begin construction prior to 60 days after the release of IRS notices and rules with respect to how to implement these various things like prevailing wage requirements, then we're gonna deem you to have met it. But we didn't know what they meant by begin construction. Well, this notice specifically let us know that they're going to apply the same begin construction concepts from the previous regime to the Inflation Reduction Act and the credits thereunder. So we were kind of relying on that guidance now to say that we'll continue over that begin construction concept.
And that date, so you're aware, is the 60 days post guidance is January 30th of 2023. So if you began construction, often what's referred to as shovels in the ground, prior to January 30th of 2023. There's also, when you think about prevailing wage and apprenticeship requirements, there's also what are often referred to as cure provisions that can be utilized to ensure you are meeting the standards post January 30th. And we obviously can assist you in that.
Yep, absolutely right. And that's what you see here at the bottom of the slide. And you'll see there's two kind of concepts that go along with these prevailing wages and apprenticeships that give, there's a quite an onerous burden on the taxpayer here, but Congress did allow for a little bit of some help. One, the ability to cure or correct the deficiency. So if it's determined after the fact that you weren't meeting prevailing wages, you can go back and correct that and still get your credit. And with respect to, as we'll see, the apprenticeship, there's a similar carve out where there's a good faith exception. Exactly on this side here, there's a good faith exception. So if you apply for registered apprentices in your locality or jurisdiction, and you are unable to get those apprentices to your job, but you made a good faith effort to get them, the IRS is going to deem you to have satisfied that requirement as well. Otherwise, though, there is this labor hour requirement concept where you're going to have to divide out the total labor hours on your project, which is all in but excludes supervisors and a few other folks. by the number of labor hours performed by registered apprenticeships on your project. And I think the next slide has a table that'll show you what percentage you need to meet. Yep, exactly. So going forward after the end of this year, you're going to have 15% registered apprentice labor hours on your project in order to meet these requirements. The domestic content bonus. So as you recall, this is a 10% adder to your credit. So if you're meeting the prevailing wage and apprenticeships for the investment tax credit at 30%, and with domestic content, you can get up to 40%. It's quite a big lift though. And from what I have heard from folks that the supply chain is actually starting to come, but this was another thing where Congress recognized that especially for some of the solar and other renewable energy efforts that were taking place in the country, there wasn't a lot of domestic sourcing of the stuff that you needed to build these things. And they wanted to provide an incentive, and they did provide a pretty big incentive to try to start building out that supply chain. And we're starting to see it come in, but you're going to have to make sure that your facility, your qualified energy facility, uses steel and iron materials that are US mined and produced. And then for everything but offshore wind facilities, 40% of the total costs for all of the components that go into your facility also must be US source derived. Okay. Energy communities. This is a geographic concept that parallels this domestic source. So the IRS or Congress passed an additional incentive to put and locate these new facilities in particular areas. And there are several somewhat complex rules that are in place around how to identify these energy communities. And that's what this IRS notice helped to explain a little bit. For example, the unemployment rate in the energy community must be at or above the national unemployment rate. And a certain percentage of the historical energy and electrical energy production in that area must have been derived from fossil fuels. There's also specific carve outs for brownfield sites, which are communities that may have previously been involved in the extraction, processing, transport, or storage of coal, oil, or natural gas. And then there's also an additional carve out for energy communities in a census tract where a coal mine closed. And so this is another area that we're seeing, a kind of a lift that we can provide where we can help people identify, because the rules do get a little bit complex around identifying some of these energy communities and whether or not you qualify for that 10% adder.
Yeah, and Tim, let me interject. One thing you may notice is that we have 2023-29, we have 2023-38. We have approximately 80 thought leadership positions out there in regards to all of the pronouncements and notices the Internal Revenue Service has published. So though the act will be 1 year old tomorrow, as I mentioned, we are continuing to see guidance, and it's really the beginning and interim guidance. So one thing we'll talk about is transferability provisions in a second. But just last week, we saw the IRS give us additional guidance. And I say additional, really, it was the first guidance in regards to the low income community for that 20% additive or bonus credit. So Tim, I think that brings us to a polling question.
All right. So the polling question is, are you aware that energy tax credits and incentives can be used in multiple ways to help your business? Yes, no, or not sure. And while people answer that, one of the things that that's kind of been a theme throughout this is that this Inflation Reduction Act, it changed the game because of the amount of credit that we're talking about and the expansion of so many of these credits to different areas and industries. That for any taxpayer that has a building or is putting in a building or does manufacturing, I mean, it's worth exploring, what might be possible and doing the modeling and the due diligence to see if this could be a helpful space for you.
Yeah, I'll give you an example as we're waiting on the polling results, which we've now seen is one of the things we see in commercial buildings is what some of you may be aware of is what's often referred to as interactive or dynamic glass, which is actually a concept where the glass on a vertical building becomes ultimately a solar array, and through an energy management system, you're pulling in kilowatt hours. And so we see that paradigm shift, and we'll continue to see technology advancing at a rapid pace. But we're here to assist you. Again, we assess, identify, and quantify opportunities from that standpoint. So if you want to post those poll results again, so Tim can cover those, that'd be great.
Oh, yep, looks like 66% said yes. So that's a decent amount. And 16% said no, and 18% not sure.
Very good. So you want to kind of talk through taking advantage of these energy tax credits, because this is where, as I like to say, kind of the credit hits the liability side or the tax capacity. So we'll talk about a couple key paradigm shifts that occurred underneath the Inflation Reduction Act. So Tim, talk to us about credit utilization, and elective pay, and transferability.
Yeah, and this comes about for a variety of reasons. One of the big ones was that a lot of the taxpayers who were historically taking advantage of the investment tax credit might not have enough tax liability to make it worthwhile, because previously you'd credit it against your tax liability, and if you didn't have it, you could roll it forward. But there was a gap sometimes in monetizing, especially at large utilities who don't often pay a lot of federal taxes, and because of net operating losses and maybe other credits. And so this new concept, there's two of them. There's elective pay, or we often refer to it as direct pay, and then transferability sought to remedy that. There was definitely a tax equity space, which is outside the scope of this presentation, but another way for taxpayers to seek to monetize their credits. And I don't think that's necessarily going to go away, but this is certainly going to provide maybe a cleaner, a direct access way for taxpayers to quickly monetize these credits. The direct pay is available for specifically for governments and nonprofits, people who aren't historically paying taxes because they're tax exempt, U.S. territories and other entities. And that's actually a mechanism by where you can have the IRS pay you directly for whatever credits you're generating on your projects. The transferability concept is kind of a brand new concept. And this is the idea that, and I think, I don't know, Ron, if you want to jump to the next slide. I know we're running up on time, so but I think this is important. So this, maybe one more to get to the transferability. Yeah. So this allows eligible taxpayers with eligible projects related to all of these different credits that you see to sell their credits effectively in a market space to buyers who maybe have tax liabilities, whether they be banks or other businesses. It's a one-time thing that you can do for cash. But it allows you to monetize the credit. And I don't know how much has shifted even just recently, but I've heard, that there's an expectation that it's going to be pretty high cents on the dollar that taxpayers are going to be able to get for their credits as this market develops.
Yeah, so what I would say around these provisions, 6417 is the direct pay provision, obviously very focused on rewarding, as Tim commented, various taxpayers, so the government writes a check. But 6418, in my assessment, is really a paradigm shift. And what I mean by that is, of course, you evaluate your tax capacity, and then you can sell your credit through this transferability provision. And we do have a thought leadership position out there that is going to be posted in the chat by our people. But as you can see, the eligibility around transferability is extensive when you look at not only the ITC, but also the PTC. So when you talk about Section 45, production tax credit, Section 48, the ITC. So we are already seeing, so there's markets developing. What we're seeing right now is a credit can be transferred at approximately 85 to 90 cents on the dollar. Obviously, that's the arbitrage in there but here's the game changer, is that the sale or the transferability of the credit has no income tax consequences to the seller. So it's really a game changer in regards to evaluating your tax capacity as perhaps the generator of the ITC or PTC, and then determining, well, if I can sell my credit at 85 cents on the dollar, and I don't pay any income tax consequence to that sale, that's a game changer. And so we do have a thought leadership position out here. We're about 411, and we want to be obviously respectful because we've got a client panel coming up. And so, Tim, why don't you kind of wrap us up from the transferability side?
Yeah, absolutely. And that's what you saw on these two slides here is actually what Ron just talked about, that consideration paid by the transferee taxpayer is not included in the eligible taxpayer's gross income, but it's not deductible by the transferee. The transferee taxpayer cannot retransfer the credit. So this is a one-time deal. And then once it's done, the election that you make to do this is irrevocable.
Yeah, so a couple items, and our marketing team's going to put in. One, we have a comprehensive energy collateral piece for you attendees, which really covers all of this in a very straightforward and detailed fashion. And then there will be a piece in there specifically around thought leadership around transferability and direct pay and the credits that can and cannot be utilized. So they'll get that posted in there. So we're at about 412, and I want to be respectful because we have the chief executive officer of one of our clients that joining us. So what I'd ask is we're going to take probably about a 10-minute break, because we have gone about an hour and 15 now, and we're going to take a 10-minute break, and we'd ask you to come back at approximately 4:25, and then we'll make the introductions, and we're going to have a client panel of someone who is real world going through the Inflation Reduction Act and finding areas for his company and some of the ways that Terry Becker can assist him. So we'll take a 10-minute break and come back at 4:25. And please stay on. So don't log off, but grab a cup of coffee or drink and come back around 4:25. It is my great honor as we go into a client panel to end our energy presentation to welcome Justin Drapeland. Justin is the Chief Executive Officer and really founder and owner of Eclipse Solar. And he will talk to us really about his experience to date with respect to the Inflation Reduction Act. And so one of the key things for participants really is to hear from a client and a chief executive officer that is really walking through and going through and evaluating with respect to the Inflation Reduction Act of 2022. So Justin, again, I want to thank you for taking time out of your busy schedule. It is very much appreciated. And as we have talked, we'll be asking a number of questions to you and getting your comments and thoughts in regards to what you all at Eclipse are experiencing with respect to the Inflation Reduction Act. So Justin, let me start out by asking you to tell us about you and the background of Eclipse Solar and tiny homes, and your vision and where the focus of the company is, and also obviously how the Inflation Reduction Act is, obviously a huge paradigm shift for Eclipse. So, Justin.
Thanks, Ron. Appreciate that. Thanks for having me. So I started on the land development side of the business with developing tiny home communities up in the upstate of Greenville. Went really, really well. During COVID, we transitioned into building tiny homes, and my focus was on wanting to build with all of the latest and greatest technology. So that meant solar, energy efficiency construction methods, smart housing technology, and we were taking all of that stuff and just putting it all into our home standard. And so through that process, we started installing a solar roofing product. We went through a couple iterations, and the one that we ended up sticking with was this integrated corrugated metal solar roof. So the roof is solar as well as the roof. And what we were looking at was how we can manage the tax credit piece with the bonus depreciation and kind of get investors to basically purchase our cottages that qualified for bonus depreciation at the time, and wrapping up this tax credit piece for those guys individually. And this was before the Inflation Reduction Act. So we were working already with Cherry Bekaert on some of that stuff. And then the Inflation Reduction Act passed, which it just completely scrambled our entire business model to the point where we said, with what we're on and where we're positioned currently, we really have to focus 100% on solar. So we started that transition to say, okay, well, this model that we were putting together for our cottages still works for our cottages. It actually works even better. Now investors can make even more money with their cottages. And then somebody came to me and said, well, if this works for your tiny home communities, could you do this on boat and RV storage? And because it's a corrugated steel panel, the Inflation Reduction Act at the time, and it made even more sense. And then somebody said, well, what couldn't you do this on commercial and industrial buildings? And yeah, so we kind of went all in on solar at that point, started having quite regular meetings with Ron, probably more than either of us would like to admit. But we talked a lot about what it meant, both what the act meant and more specifically what it meant for us. One of the problems that we had was in the tax credit space, specifically as it came to ITC, there's a set mindset with the people that have been doing it for 10 plus years as far as how ITCs are supposed to work. And the problem we ran into was many of them didn't even understand why they were doing what they were doing. They didn't understand how the model worked or why the model worked the way that it did. So when we talked to them about our product or our model, they didn't even understand, because all they knew was A plus B equals C, A plus B equals C. And it took, in fact, some of them, we had already understood it better than them when we talked to them, and we had to help educate. And that's where Ron came in handy. And Ron actually helped educate some of these potential tax credit buyers and syndicators on the whys of the tax credit and how the implementation of this has changed the paradigm of it, which makes our model easier to manage, easier to transfer, less risk than the traditional tax equity structure would be. So it was important for us to find somebody that actually understood the why, so we can have a intellectual, educated conversation about what we're doing and how we want to do it, and kind of help guide us as far as the best way to approach that. So that's kind of where we're at. And now we're all in on solar with I don't know, a couple $100 million worth of projects in the pipeline. So
Well, obviously, Justin, Eclipse is a very exciting company. You have really a lot of things going on, and the energy space for sure, to your comment in the pipeline. So when you think about the pre-Eclipse and then the post-Inflation Reduction Act, what do you see, and what continues to be your vision over the next 10 years? And what do you see Eclipse accomplishing? Because you mentioned the technology, but what is the Inflation Reduction Act and the expansion and the bonus credits really meant for Eclipse to accelerate your business?
yeah, so a couple of things that we already had going for us, again, which is why we were in the right place at the right time, was we were already looking at moving the manufacturing of that solar roof into the US. So we had already started that due diligence process, sourcing equipment, working with vendors to do that prior to the Inflation Reduction Act. So the domestic content bonus was like, are you kidding me? It's like they passed this bill specifically for us. We're also already an opportunity zone business. So our manufacturing company is an opportunity zone business. Opportunity zones fall into that low income category. So many of our projects that we were looking at were already opportunity zone and low income qualified for that adder. And then, you add in the energy layer. I mean, we basically looked at this and said, we're already at 50, 60%, 50% basically of guaranteed if we're in that zone. And then, the extra 10 to 20%, there's an application process, I understand. So it's maybe not guaranteed. We just don't know enough about that process yet and the approval rates. But knowing that we're made in the USA, knowing that we're targeting opportunity zone projects, we already know that our percentage is going to be higher than the average solar installer. So for us, the Inflation Reduction Act was a complete game changer because we went from, doing our modeling on, 26 or whatever it was, then 22 and dropping to 15% or however that was going to work out with the old credit to 50 and extending it for 10 years plus. So it was a complete game changer.
So Justin, you mentioned that really you were already planning, to your credit, pun intended, obviously the manufacturing of solar panels in the US, and you talked about the 10% bonus credit or additive credit. So we know that just strategically, when you think about solar panels in the United States, 80+% are being imported, significantly amount out of China, et cetera. And they obviously don't meet that extra 10%, quote, made in the US criteria or business component. So, I mean, what's the vision and the impact that you are going to see as the manufacturing facility that, is coming on board? I mean, I know that, a lot of companies have already reached out because of the additional 10% additive. So what do you see? I mean, do you see that manufacturing just for Eclipse, or do you see that expanding really to sell US panels and specifically your technology to others, recognizing that it's just a unbelievable growing market?
Yeah, I mean, we definitely plan on eventually expanding. We're trying to get one line up and running now. We have equipment that's already been purchased. We're setting up I'm in the new facility, so that's currently getting set up. And we're simultaneously working on building a larger facility. And that facility would have the ability to produce $2.5 billion of solar annually. And then, I don't want to get too far ahead of myself, but we would be looking to build additional facilities in other states as well. Assuming, there's a lot of steps to get to that point, but we have the game plan in place. We have the business lined up already to get us there. And we are regularly turning down people that are like, oh, this is the perfect product for, my cabin or carports or my storage or my building and all this kind of stuff. And we're kind of just telling people, we're really not ready for you. We have too many projects already lined up. But we need, it's a new business, right? So it's like we need the business, right? So we want to take in some business, but then we need more investment to get to that next level, and then we can make in more business and then more investment. So it's just that balancing act currently of ramping that up. But I definitely see us doing. I can visualize and have the game plan to get to $2.5 billion annually of revenue. Where we go after that is still to be determined. I believe we will have the ability to go bigger than that, because I look at it as being a steel integrated solar, that structural capability, because we can be a full roof. It makes it so we can cover anything. So like, to me, all these parking lots that are putting up like a solar panel, but the reality is those leak, right? They aren't structural. They aren't really protecting from the elements. It's giving some solar power, whereas ours actually adds that layer of protection to what's underneath it, protects it from rain, sun, all that kind of stuff. So I see us, eventually expanding into covering all these parking lots that you see all over the place and just using our product over the parking lot to give the buildings solar and coverage and all that kind of stuff. There's just so many applications to our product when it comes to this. We just can't run fast enough right now. Right?
Right.
That's our problem.
Well, the demand clearly is there, as we know. And so as you commented, you're approached almost on a daily basis in regards to the panels and the roofs. So one of the areas we've assisted in that I'd like you to talk to, because we kind of finished the prior presentation in regards to what I see as a significant paradigm shift when you think about what are referred to as the transferability provisions, or the ability for you to sell the credit. And I know that is a group we introduced you to, and you evaluated, and we're in the process of working with on a national exchange basis. But can you tell us a little bit about your experience today in regards to the transferability and the ability to sell the credit while not having any income tax recognition, and kind of what that means for Eclipse in regards to the credit transferability and the sale of the credit?
Yeah, so it's important to make sure everybody, and I'm sure everybody's aware that like these transfers aren't taking place yet, right? They've told us how they're going to transfer. So we know the logistics generally, but nobody's actually doing it yet because the systems aren't up yet from the IRS, right? So we're having a lot of conversations, and some of them are really quick and some of them take a little longer. And we've talked to several different groups, many different groups really. And some of them, like, they don't understand the space yet, and yet they're building out an exchange. So when we have a discussion with them on what qualifies and all this kind of stuff, like they're just playing in a different playground. Like they just don't even understand what they're doing yet. And so the group that Ron actually connected us to, like, understood it clearly. They're like, oh yeah, your projects don't need an appraisal. We're already doing everything on a cost basis anyway. So like you got one set of thinking that has these old rigid rules that say your project needs to follow this, but they don't even understand like why those rules got implemented were to address something else over here, right? That got changed. And what we're saying is we're going to take over here back to the original. So we don't need this. We don't need your Band-Aid over how it was supposed to be done. We're just doing it how it was supposed to be done. And so we talked to another group that just didn't. Several groups actually are still stuck in that old mindset of not even understanding what changed and how it changed over the last 10 plus years. So that's been important, is just finding the people that actually understand that aspect of the tax credit to begin with, and then managing that transferability piece. People are all over the board on that. We talked to people that wanted 65 cents a watt up to over 90 cents a watt, right? And we've got people that have emailed us term sheets or requesting that they provide us a term sheet on tens of millions of dollars of tax credits, right? And again, we haven't closed anything yet because there's still, we just don't have the tools yet, according to the IRS, to actually do a transfer. So the interest has been good. The liquidity seems like it's going to be a lot easier for all parties involved to transfer that credit. So to convert that credit into cash to help fund a project or to help reduce the capital expense of a project. So I definitely see it being it's a key to our business model. I mean, if it wasn't for the Inflation Reduction Act, like we may not be able to manufacture solar in the US. So to that regard, it's doing what it was meant to do. It's creating demand for solar. It's creating interest in solar. It's bringing manufacturing into the US. So I definitely see it working and working relatively quickly.
Well, one of the things I know we're working on with you all specifically is in regards to what really is the quality of the credit. So when we think about the infrastructure to where we have the transferability provision where we know the IRS gave us guidance, and we posted our thought leadership earlier in regards to the transferability provisions, because they've given just the interim guidance really June 21st, and the transferability, at least on the IRS side, doesn't come live in October. But talk a little bit about your experience with us around what we refer to as our solar cost basis analysis, the quality of the credit, obviously the prevailing wage and apprenticeship requirements, and how we've been able to work collaboratively together to advise you on how you will ultimately bundle what some may refer to as a quality of credit deliverable to that purchaser, to ensure that you are maximizing the credit purchase, so that you're not down, as we've talked about, in that 65 cents. So talk a little bit about the experience on that basis.
Yeah, we're going through that due diligence package with Ron. Actually, we have another meeting later this week about that exact thing, of just buttoning up what is the breadth of documents. And I think we're up to like 37 documents that need to be generated. And some of them are lots of pages long, right? So it's like a book of deliverables. And I know that is important because I know the IRS is putting an onus on the buyer to do some due diligence. So we basically are doing that due diligence for them and just giving them the entire stack of due diligence items. And some things that, again, we're looking at a little differently is just how it's calculated based strictly on the cost of the qualified facilities versus some other methods that have markups and all this kind of stuff. It's sticking within the parameters of IRS and not trying to get too cute with it, right? But then giving that whole breadth of due diligence from Cherry Becker's helping to arrange the legal opinions on each tax credit sale. They're writing their own memo, including cost segregation on the entire project, to match the legal opinion as well. And then, documents for tax returns and all of that kind of stuff. So I know they're working on more and implementing more as well. But they've, for better or worse, become our one-stop shop for all things tax credit and ITC. Ron is I call him more than my wife, I'm sorry to say. But
well, the important thing is the important thing is that Eclipse is obviously just underneath your vision as the CEO and the owner has just got unbelievable, exciting plans. One of the things I want to go back to is how we're kind of assisting you so you can take advantage of the Department of Energy, and whether it's the LPO program or the grants and some of the funding, specifically in the manufacturing facility. So you kind of want to comment on that, and I'll also add in to how we're assisting in that grant / Department of Energy LPO program.
Well, and honestly, in some of this stuff, I'm probably more of a hindrance to its progress than a help, because the reality is I don't understand the majority of what this stuff is, right? So especially when it comes to like writing a grant and that application process, I'm totally deferring to you on all of that, right? So it's the extent of my work with those things is, hey, Ron, have we done anything on that yet? And so I can't really speak a whole lot to that because again, that's kind of outside my purview. I'm kind of putting that back on you, Ron. So I think you can tell them more what you've done than I can, because I'm just the one pushing.
Well, I think the key is, and obviously, as I mentioned, we work very collaboratively together, and we're very fortunate to represent Justin and his company. But in our sessions, we touched on one of the key provisions or key areas, again, a policy statement like prevailing wage and apprenticeship requirements and some of the bonus credit requirements, was when you look at the Inflation Reduction Act of 2022 and what was ultimately passed, you find that there's probably about $750 billion that are available when you really look at the 2,700 plus pages. Most people refer to the 375 billion to 500 billion that really was more scored in the bill around the subsidies. But what we focus on in helping our clients, specifically Justin in the manufacturing facility, talked about the equipment, was to ensure that we, based on our relationships with the Department of Energy, are being very proactive, not just for Eclipse, but really all of our clients when it comes to the Department of Energy grant programs and what are called guaranteed loan programs. And so just as a reminder, there's about $350 billion out there that can be applied for, that ultimately opened up February of 23. And so even the Department of Energy and what we call our initial assessment meetings will comment that, well, we're really not ready for you to file the grant, but it's clear to us that you would qualify. And the hope is that, funds once submitted, and we go through really a 5-step process with the Department of Energy. But the one that we're really focused on is really the Energy Infrastructure Reinvestment Program, which is $250 billion to help companies, specifically like Eclipse in their manufacturing facilities, to really begin to onshore and really build manufacturing facilities in the United States. And so we're assisting in that, Justin and a number of other clients, because of the magnitude of the opportunities that really are within the Inflation Reduction Act. And clearly the IRS is still trying to catch up through a number of notices. They just released one last week, specifically in the low income area, that additional 20% credit that Jason or Justin will obviously qualify for, and even we talked about it. So, but out of respect of your time, Justin, let me say thank you for being with us today. As always, your vision and your ideas and concepts are a step ahead. I hope, which we know Cherry Beckert is assisting you, and we've got a journey here. So I'll thank you for being with us today as a panelist, and we hope that those that attended learned a little bit more about what's going on in the Inflation Reduction Act specifically, and then how we as Cherry Beckert, might be able to assist and help. So Justin, thank you very much. This concludes our second session. So let me thank you again for joining us. If you have any additional questions regarding today's topics, please reach out to myself or Tim or David. All of our contact information is in fact in the presentations that you'll be receiving. As a reminder, you'll receive your CPE certificates in about 10 days. I want to stress that we value your feedback and ask you to take part on a short survey that will be sent after today's session. We're always looking for areas to improve and educate. And I will say there's a lot of education going around the Inflation Reduction Act, as Justin highlighted. We spend a lot of time based on our knowledge helping and assisting drive the $2.5 billion and the pipeline that Justin has. I would remind you that day 2 of our virtual conference will take place tomorrow from 11 a.m. To 5 p.m. So we hope to see you there. We always like to underpromise and overdeliver. So we're going to end on obviously a Tuesday, a little bit early, around 4:55 for you. But again, I want to thank you again for joining us today. We hope you have found it very educational, very informational. But again, if you have any questions at all, please feel free to reach out to me or my teammates and Tim and David. And I would tell you our energy team is at Cherry Beckert is approximately 15 plus people. So we're a big team, and we are here to help you.